Hi everyone, it's Darren and Kristian, and welcome to summer 2023. I want you to stay tuned for the next few minutes. We have a number of really important charts and slides and other things to keep you updated on what we're seeing in the markets and in interest rates in the economy and where we think we might be headed in the next little while. So Kristian, welcome to the show today.
Yeah, thank you for having me again, Darren. Excited to get right back at it.
Perfect. Well, let's jump in because I know everybody wants to get back to their golf games and whatever else they're doing today. So we'll begin with a word from our lawyers. So 2 out of 3 dentists agree and your mileage may vary. Okay, so why don't we begin where I think most people are thinking and what's kind of driving interest rate policy and other things. And let's give everybody an update on inflation. So for people that are viewers of my Walking with Charlie series that I haven't done for a while, I talked about inflation being an issue several years ago because of the amount of money they spent to fight the lockdowns from COVID. And so, of course, we did see inflation spike just as I've read the textbook, so I knew that was going to happen. But Kristian, where are we now? What is this chart telling us about what's happening with inflation in the short term?
So as a broad update to the inflation picture, we're once again utilizing a time series illustration of headline and core CPI over time. So it's evident from this chart that headline and core CPI peaked in the fall of 2022. But if we see that black line on this chart, and that's core inflation, it's really now stabilized around 5.5%. So now what I would like to do is really analyze what our expectations for inflation are over the coming months now that we've seen this deceleration in inflation, what's driven this deceleration in inflation to date, as well as other factors that we're looking at that's kept that core inflation number elevated.
So let's jump to this next module, which I think will break that inflation component down a little bit, right?
Exactly. So starting on the left side of the chart here, we have goods inflation. And here we see that it's really rolled over quite significantly and is nearing the levels that it was pre-pandemic. For perspective on what's driven some of this inflation, and you mentioned going back to our textbooks and basic economic theory, and just as a broader comment before we go into that further, the major COVID-era fiscal packages in the U.S., that was the U.S. CARE Act, we have an American Rescue Plan, congressional bills, provided 4.5 times the size of stimulus that was provided during the Great Financial Crisis. So, and naturally, in accordance with economic theory, these expansionary policies stoked inflation. Initially, this sticker shock from inflation was derived from heightened good pressures from commodity prices rising and a lot of the supply chain stresses that we saw arise during the pandemic. And that's where we get this good side inflation on the left side of this chart that really you can see peaked quite aggressively. And that led to a lot of these headline CPI numbers peaking in the high single digits and close to the teens marked in the fall of 2022. This unusual distortion in goods CPI, while it is rolling over, actually made its way over to the used car market. Here, we're also seeing a little bit of a decline now again after it rose towards the start of the year, and this should bode well on the used car prices, although I will mention it is still quite elevated relative to historical levels. Lastly, we have rent inflation. So rent inflation, a key metric that we want to look at here is asking rents. And that's usually a precursor for primary rent inflation, and that's captured in the services component of CPI. So when we're looking at this chart, just pay attention to the green line, and specifically the green line at the bottom of this third chart. That is the actual rent prices. So here we can see that this too has peaked towards the end of this year and the beginning of this year, and asking rent, so that's the precursor for what people are actually looking to rent their homes and their apartments out at, have begun to decline. So here too, we should expect that rent inflation will come down over the coming months, and this will drive a deceleration in CPI as well. Lastly, I wanted to look at sticky price inflation. So the Atlanta Federal Reserve has a separate measure known as sticky core CPI. This is essentially a weighted basket of items on a core basis that they view as changing prices very slowly, including services which are upweighted in this index. So here too, we see this data is also rolling over. And so that just bodes well further for the picture of what headline inflation is expected to do over the months, as well as some aspects of core inflation. But as I mentioned in the previous slide, core inflation has started to flatline around 5.5%. So even though we may expect headline inflation to continue to decline from these factors, the labor market remains very sticky. And I think that should bring us here to our next slide.
This is about labor and job openings, right?
Exactly. So when we're looking at the labor market, there's a couple key things to keep into consideration. Firstly, just as a background, labor and specifically wages have a direct correlation to price levels. And most commonly, this is captured through the services market because those aspects of the market are very labor intensive. And so while temporary hiring may have picked up in May, when that's typically a strong indicator for the labor market, broadly speaking, we're beginning to see some signs of relief. So job openings have begun to tick downwards, and we can see that they peaked at what looks like in March of 2022. They're still very elevated relative to the historical norm, but they are trending downwards. The quits rate is also trending downwards, and that's a helpful statistic because that usually shows the amount of people that are willingly leaving their job to find better employment elsewhere. And we can see layoffs have ticked up a little bit, but the unemployment rate is still actually quite historically low. So what does this mean in terms of core CPI and labor? Well, essentially, the conditions have begun to present themselves that we may see some relief in the labor market in the coming months, but they are very elevated relative to the historical levels. And so when we filter this into the CPI picture, it likely means that CPI and core CPI especially will remain more elevated in the near term before we see a lot more relief from these indicators present themselves.
Okay, so we're looking at kind of the cards in the deck, and we're seeing same type of information that obviously the central banks are saying. They have even more data. So that is going to drive the interest rate policy. So interest rates stayed very low for very long. They then, despite them telling us they would stay there, they started to dramatically increase interest rates. So now we've seen this incredible surge in rates. Where do you think we're headed next? Because I think that for a lot of people, that's really, because that's the brake pedal that they have to try and slow things down. So I think first we're going to look at US interest rates, because that really does drive a lot of what happens everywhere. So this is now what the Fed thinks inflation is going to do. So again, these are the cards that they have, which should tell us what they're going to play next.
Yeah, exactly. And so certainly they have more data than we have. And as we mentioned, there are conditions here that look like will keep inflation a little more elevated, including the job vacancy rate, which was the job openings we looked at as a percentage of the labor force. And so the Fed itself has started to indicate that their expectations for near-term inflation is actually higher than what they predicted at their last meeting. So the Fed just went through their latest meeting in June. Prior to that, they met in early May. And what we have here is their dot plot of inflation projections. So the June projections are those dark shaded blue boxes. The dotted boxes are their March projections. And essentially what you can take away from this chart is their inflation projections are beginning to be a little more skewed to the right hand of this chart. So their inflation projections are increasing a little bit, and that's based on the data they have. And in turn, that feeds into their interest rate expectations. So that should bring us to the next chart.
Yeah, because fighting inflation is diabolically hard,
Yeah.
as they know and that we're all discovering.
So the Federal Reserve produces this dot plot, and this is based on the members of the Federal Reserve, the voting members, of where they expect inflation over the next 3 years and the longer run. And essentially what you can take away from this and their latest meeting is that despite they had a pause, and the term on the street right now is a hawkish pause, because they have signaled another 225 basis increases. So they've increased their median rate based on this expectation to around 5.5%. So they're signaling that although we're near the end of the Fed hiking cycle, there likely may be one or two more rate increases needed to combat inflation. And for the longest time, if you read their public policy messaging, their primary goal right now is to maintain price levels and keep inflation down. So to do that, they need to have monetary policy that is restrictive enough to start to ease the labor market stresses and bring the inflation down to a level that they think is consistent with long-term growth. And that's around 2 and 2.5%.
So still a long way from now. So inflation's being more persistent. So rates might stay a little higher for a little longer. So when we look to Canada, we're seeing a
Yep.
pretty similar picture, aren't we?
So in Canada, it's an interesting case because our Federal Reserve the Bank of Canada did pause earlier than, I guess, where the U.S. is in their hiking cycle, but they've now reinitiated their hiking campaign. So they just hiked again at their latest meeting, and really what that meant is there's actually another hike more likely now in July as well. So we've just had here a forecast of the implied rates based on one of the economic services we use, just to show you where rates are at and where they may be headed. But really, what I wanted to show here is why did Bank of Canada decide to rehike again? And there's a couple factors. GDP and inflation data continues to come in hotter than expected. So on one hand, that's good because that means the economy has continued to be strong. But on the other hand, that means inflation has also continued to persist. And one area of the economy that is particularly cyclical and very sensitive to monetary tightening is the housing market. And within the Canadian housing market, we too are now seeing a little bit of a bottoming, and prices in real estate within Canada is starting to increase. So the chart on the right here includes two metrics. One is just the MLS house price index, and that just shows the aggregate of the average house prices in Canada. You can see it kind of bottomed at the beginning of the year. It's starting to tick upwards. The other thing is the sales to new listing ratio, and this is an indicator that typically is a precursor to house prices. So you can see the charts overlap quite well over time. And to that respect, it's possible that it's indicating that house prices may actually begin to accelerate further. That's not great news for the inflation picture because shelter, as we talked about previously, is actually quite a big component of inflation, representing around 10% of the overall price basket. And so this means for the Bank of Canada that maybe monetary policy is not quite as restrictive as it needs yet to bring inflation down to the levels that they're looking for.
So this is very tricky, right? Because again, it's like they're in a race car and they're trying to gauge how much brake to put on to slow the car down without putting it into the ditch. So I think the hope is that we're going to avoid a recession. So there's a lot of talk in the press about, are we going to have a recession? Aren't we going to have a recession? So you've taken a look at some of the determinants of a recession. So if we look at kind of the map, where are we right now? Are we in a recession, do you think? Is that what the data is showing us?
So if you entered this year in January, and you're maybe tuned into CNBC or BNN, you may have had some pundits screaming on there that we're in a recession and very doom and gloom. But really the data to date indicates we're not in a recession, and we may not actually be particularly close to a recession. Economic data continues to surprise the upside, and that's measured on that bottom chart there by city. So you can see above the linear trend line around zero, economic data continues to be better than expected. And the NBER measures their factors of recession determinants, and some of these are lagging indicators. And the saying often goes, you don't know you're in a recession until you're actually in one. But essentially, based on their determinants here, the green or lightly shaded green / yellow hues means the data is still fairly strong, not indicative of a recession. Dark red obviously indicates we're in a recession. You can see that happen during the COVID period. So the data may be trending towards a recession, but certainly we're not there yet. And that brings us to our next chart, which really describes why has economic data been better than expected, and why are we not in a recession yet, and maybe why do we have time to go until we could enter a recession. So part of this is the chart on the left, and that's the payroll index, and essentially that feeds into real earnings. You can see it's actually got quite elevated post-COVID, and it's beginning to trend downwards towards its norm, but people are taking home more money than they were in the past. And as a precursor to that, and also as a result of all that funding I had mentioned early in our presentation, people saved a lot of money during COVID. We know you couldn't get out of your house.
Because they didn't have anywhere to spend it. You couldn't leave your house. You couldn't put in a pool. You couldn't get a new car.
Yeah,
no one needed to buy pants for 2 years.
Yeah, there was really not much to spend it on. And so there was net excess savings during COVID of $1.3 trillion above what we
And
would
this is, by the way, this just so people know, this is just for the U.S., but we saw a similar pattern in most westernized countries of just savings rates being unheard of. We've never seen this pattern before.
Yeah, precisely. And so we are now seeing this savings. You can see there we've had 1.1 trillion in this savings, but that still leaves us with quite a bit of money still on the sidelines, quite a bit of dry powder for consumers to deploy over the coming months. Consumers are spending at a rate about 60 billion a month right now. So this savings is not sustainable. Eventually, all this capital that we saved up during COVID will be drawn down, but there is still quite a significant amount of capital left for consumers to spend on, which will keep the economy propped up, in our opinion, for the coming months.
Now, one thing I worry about a little bit is what the impact of all the higher interest rates are on the average consumer's pocketbook, because the consumer spending drives so much of what happens in the economy. And we've been talking in many cases about what it means to mortgage payments and what that does to cash flow. But there's a lot of other places where it hits. And I'm going to see, I watched a couple of guys on a podcast recently, and I'll see if I can post the link to it, where they looked at what's happening. We talked about the used car market and how hard it was to buy a car. And they pointed out that the average new family car in the US, the price of it's jumped up quite a bit, but so have the financing costs. So if you take the higher price of the car and the higher financing costs, what they showed is that the average person to buy that average car, where their payment used to be about $500 a month, is now over $900. So the impact on the individual family's cash flow is fairly dramatic. So while we see rents maybe coming down a bit and mortgages have gone up, other areas are also impacting them. So that'll be interesting to see how that flows through to what else they can spend on. But we also know, and I don't have this chart here, but we've used it in the past, about debt utilization had dropped. So not only have people saved money, they also paid off their debt. So I guess what we're getting at is a lot of cross currents here of good news and bad news. And I think it's also important to point out that for people that are fearful, that hasn't worked as a strategy. And I don't think it ever works as a strategy. But one thing that we've watched this year in the market, which is interesting, is how I joke that it's like everyone's crowded around the same slot machine. So why don't we move to that and talk about what we would call market breadth, which is how healthy I think is the investment market, how healthy is the investment community. Oh, we didn't finish the recession one. So this is, before we get to that, probability of recession. So you're saying, the data is saying we're not in one yet. How likely are we to be in one soon? Because I would argue that the Federal Reserve and the central banks around the world are trying to engineer one. Will they be successful?
So Milton Friedman often said monetary policy has long and variable lags. So we don't know the extent of how long all this tightening filters through. You said it impacts so many parts of the economy. It's so difficult to determine when and to the extent of how much all this tightening is going to impact. Certainly, as we discussed in our last presentation, the amount of tightening, the pace of tightening specifically, is at a historical level. But we haven't seen all that impact flow through. Some estimates that said maybe 50, 60% of the tightening has filtered through the economy. It's very difficult to determine. But if we have some available insights here from our economic resources that we use, capital economics, for instance, is that there's a 100% probability of a recession in the next 12 months. Based on their data, you can see the dotted lines. It's very rare that when they've had these indicators peak above 50%, that there hasn't been a recession. So take that for what you will. We also have the ClearBridge recession risk dashboard. So they look at a number of forward-looking indicators or indicators that have often been associated with a recession. I believe it's 10 out of the 12 indicators, if my math is right, is a red X, which means a recession is foretold, and 2 of them are cautionary. Again, based on their proprietary recession risk dashboard, when they've had this extent of negative precursor indicators, they've had a very high probability that a recession has occurred. So the forward-looking data indicates that we're likely due for a slowdown, but Darren, you mentioned this is what the central bank wants. We have very tight labor markets. The only way to get labor markets slack is at the end of the day to increase unemployment. When you increase unemployment, you usually result in a recession. It's very difficult to get that happy medium where unemployment or labor market slack eases, but you don't have a corresponding increase in unemployment.
Right. So just I think for viewers, where we're taking this is there's so many data points. One thing that's a bit of an old joke on the street is that economists have predicted 11 of the last 3 recessions. So they tend to see the boogeyman under the bed quite a lot. Operationally, I'm taking the view, we're taking the view and investing with the view that a recession seems to be inevitable, is just part of like the weather, if you will, of the economy. We get them from time to time. I think it's pretty clear that the central bankers are very much determined to create one to bring inflation back down, slow down some of the excesses that frankly they caused with all the spending that they did to get us through the lockdowns. So I think it's inevitable, but the timing of it's impossible. So we're mindful of it. We're going to talk in a few minutes about how we're positioning a couple of ideas to take advantage of the change in interest rates that are coming from this. So this is all part of on our radar, but I don't walk around being terrified of a recession, just so that people know that. But what does concern me a bit, and sorry, I did jump ahead, is this idea of market breadth, because I've done this job for 30 years and I've seen what kind of happens when we get this narrowness. But this is particularly shocking. So the last time we saw anything close to this was in 2018, where the market was driven by only a few securities. And if you didn't own them, you didn't really make much of a return, which is interesting because it masks the way that the index is calculated, kind of masks what's going on under the hood. So just so people remember, the S&P 500, which is a measure of the 500 largest companies in the United States, that's one of the most common barometers. It's measured based on size of company. So the biggest company is got the largest weighting, second biggest company, second largest weighting, and so on. So if the biggest companies are going up and people are adding to the index, the bigger get bigger. So there's this interesting momentum effect. But if you only look at the top line number and you're not aware of what's happening underneath, you can get a lot of incorrect signals. And I think right now is very much the case. So do you want to just take us through maybe that first chart on the left, Kristian? Because I think this is a really interesting story for investors to be aware of right now.
Yep. So if you've tuned into news programs or you've been on Google recently or Twitter or any social media platform, AI seems to be the topic du jour. And so there seems to be almost a frenzy around AI where any AI-linked stock has really taken off this year. And so this chart just really shows that divergence. So BCA Research, which is also one of the economic research platforms that we use and interact with on a constant basis, what they've done is they've charted the S&P 500, excluding AI-linked stocks. And so they're listed below the chart there, but they've determined these stocks have a high concentration to AI, or within their earnings releases, they've mentioned AI several times. The market without AI, fairly flat. If you include AI, and it looks like it's about 15 names there, market is up, S&P 500 up over 10%. And this was based in early June, it's close to 15% now. So there's over 10% disparity just based on AI. And Darren, you mentioned.
So if you were a prudent investor, you'd owned banks and real estate and natural resources and consumer discretion. If you had a broadly diversified portfolio and you chose not to overweight AI, you haven't really made any money this year, despite the news headlines saying it's been a banner year, it's a bull market. I would argue that it's been a massive bull market for a few things. Everything else is just kind of lying there waiting to do something, right?
Exactly, and that's on the AI side. If we say, okay, let's just look at it at a market cap, which you mentioned goes into the weighting of the index, the S&P top 10, and those are our mega cap stocks, they're up over 30% this year. The rest of the market is up 5 to 6%. And if we actually concentrate that a little bit further into what's now coined S&P 7, and that's Apple, Microsoft, Amazon, NVIDIA, Google, Tesla, and Facebook, they're up almost 60% year to date. Rest of the S&P is up 2 to 3%. So altogether, the market is up 15%. Looks fantastic. Most of that just within 7 stocks.
Right. So this is why I make the joke that it's like everybody's crowded on the same slot machine and they keep putting their quarters in. I know there's no quarters in slot machines anymore, but I'm an old guy. And that, to me, every time I've noticed this, whether it was Nortel or .com stocks or potash or cement, blood therapy drugs, weed, cannabis. Whenever people get really excited about one idea, it never tends to end well. So I think people should know that we're aware of this. We've benefited from this in certain parts of the portfolio, which we'll talk about in a minute, but is definitely not an area where we're saying throw everything else out and go after just those things. The momentum of this is a little scary for me as a prudent conservative investor. So we don't mind not throwing all of our chips onto, betting on that one number. But also too, historically, where does this tend to be? So give us some perspective on this. I've seen it, but I think it's important to look at the numbers about how long does this tend to happen and how long does it tend to go on based on history?
Yeah. So first, I'll just say, going back to 1990, so available data to 1990, since before that the data gets a little murky. This is the largest outperformance of the S&P market cap. So that's the S&P you'll see on all your quote screens. If you're watching CNBC, they'll have the S&P 500 market weight. It's the largest divergence, the S&P market weight versus equal weight going back to 1990. So we're obviously in an unprecedented time in terms of market breadth, and these charts show you regression trends of how long can this last where large firms outperform the rest of the market. And the particular chart I'd like to focus on here is the chart on the right, because this puts it back to a baseline of 0. So when you're above the line of 0, that means large firms are outperforming. And when you're below or at 0, that means they're performing in line with the index or they're performing below the index. So what does this tell us? This tells us that essentially it is very rare for large firms, so we talked about that S&P 7, to outperform for a sustained period of time over history. It can last months, but it very rarely lasts years, where large firms outperform the rest of the market. Eventually, we see they regress back to 0, and to an extent, there's periods where they underperform the rest of the market. So that just speaks to the sustainability of what we're seeing right now in the S&P 7 and S&P 500. It's difficult to see this market breadth continuing, and the outcomes for what can happen are actually quite binary. It's either the rest of the market begins to outperform and catches up to them, or they regress back to the rest of the market. And certainly at the levels we're seeing now with S&P 500 and given some of those recessionary headwinds we mentioned, it would be difficult to see the extent of the upside given the financial conditions. So that just goes to speak that these conditions, while they look good on the surface, we question their sustainability.
Yeah, and the image I'd like investors to take away from that is, like, imagine you're stretching an elastic band and these only a small number of businesses are still pulling forward, and either the band goes up this way and it works out great, or it snaps back the other way. And given that we talked about with the recession indicators and interest rate policy, and it looks like they're trying to generate a recession, it's more likely to me that these high flyers have to come back down to earth to some degree, and we get more broad-based participation than it is to keep banking and betting on. History's not on your side, I'd argue, that if you want to keep betting on these companies, keeping getting bid up higher and higher. But hey, the market's an interesting place, so we'll see. Let's go to returns by sector a little bit to see kind of what is happening, again, when we kind of open up the hood to see where different types of investment strategies are working and what may not be working so well. And I think also where there's huge opportunity too.
Yeah, so we can start here for a more granular view. If we just look at returns valuations by style and market cap, we thought it'd be helpful to display the disparity today in what's been coined as value and growth equities. So here, those growth names are a lot of those AI-linked names that I mentioned, and certainly we saw the outperformance in those charts we showed a couple slides earlier. But when we look at value-oriented names, and those are names that we expect to be positively valued in terms of price to earnings, relative to their historical trends, relative to the market, they have earnings growth over time. There's a number of factors that go into the value classification. And certainly, Darren, I know you would like to speak to what we've liked about value-oriented entities, but the takeaway here is that they've not performed well to date relative to the rest of the market. So it's been very difficult to find pockets of the market that have performed well, given the disparity that we've just spoken about the last couple of charts.
Right. So everybody seems to have forgotten the textbook. So instead of buying businesses with long-term historical capability that have fortress-like balance sheets that have the ability to set price, these are things that people aren't paying attention to. They're like, ooh, if it has AI, I'm going to buy it. And I remember back in like 1998, it was like, oh, if it has a .com, I'm buying it. In 2014 or 2016, maybe it was like, well, if they're in the weed business, I'm buying. So anyway, but that does set up, I think, an opportunity for us to go to places of the market, particularly in places like financials, real estate, that haven't participated well because the interest rate move really kind of hurt them. But they're generating enormous dividends, and we can buy them at prices we haven't seen for a long time. So for me, the fact that we are seeing this disparity of where people are allocating their money, I think it gives us huge opportunity to really go to where no one's paying attention. And 2 points to this. One, the oldest rule of investing is buy low, sell high. People are not doing that. They're buying high and selling low. We will continue to be prudent and disciplined. The other thing that I always keep in mind is this quote from Warren Buffett. Well, he has many of them, but one of my favorites is, he says, in the short term, the market's a popularity machine, and it's a voting machine, and it votes for what's popular. But in the long term, it's a weighing machine, and it weighs value, the quality of the business, the quality of the earnings, the quality of the operations. So as long-term investors and patient investors, I always go back to that and respect that different ideas can be popular from time to time. Doesn't mean we have to invest in all of them. The other quote he likes, and because my son's a baseball player, I like this one. He says, we don't have to swing at every pitch, which I think is also something to keep in mind. We don't have to jump on every crazy idea just because it's got some legs to it. So I learned in high school it's not important to be popular. Anyway, so why don't we move to another couple of areas of where because I appreciate people still tuning in after half an hour. This is also quite interesting, back to where is there pockets of value and where are we seeing things that people maybe aren't really paying attention to, and kind of performance of financials and real estate. Just take us through this chart because you've highlighted some of the boxes here.
Yeah, so with this chart here, I just wanted to further evidence some of those key areas that we classify as value and really high dividend paying entities. And Darren, I know we'll speak to the importance of dividends, especially in this environment. They obviously haven't performed well to date. And part of that is the regional banking crisis within the U.S., which seems to have largely subsided. And a lot of significant financial institutions, I think, being incorrectly lumped together with some of the smaller regional banks, and especially in Canada as well, some of our financial institutions being hit as a proxy of relation to the U.S. But when we see that, and we see those dividend-paying entities that we continue to love and want in our portfolios, dividend-paying growing entities, and we compare that to the sectors that have done well, and that's consumer discretionary, tech, and comm services, and those are the areas that often have AI linkage, especially tech and communication services. They pay little to no dividends. And so, Darren, I know you've always spoken about the importance of what a dollar will buy, and maybe you can just go further in this respect of why we continue to like dividend-paying entities in this environment.
Yeah, and it's interesting because for 30 years, I've been saying to people, look, my job is not to protect your capital. It's not to protect your dollar. It's to protect what a dollar buys. So because our focus has always been on the real challenge when people retire, it's not just about achieving a comfortable retirement. It's about being able to stay comfortably retired. And so that's always a fight with inflation. That's the dragon that we fight. So I've always looked to find investments and strategies that performed well in those environments. And it doesn't mean that everything works every day, but what works well over all the days. And people know this. Like, this is like, I feel like I got to tell people to take their vitamins and eat their vegetables, is you have to remain a large part of your portfolio biased to investments that, by their nature, by the way the businesses work, benefit from rising inflation. So those would be real estate. So we want to be landlords, even though from time to time it might not be in favor, or interest rates can move suddenly and change your math a little bit. But over a long period of time, we want to be owning high quality, hard to replace assets, real estate and infrastructure that generate returns that are running higher than the rate of inflation. So that's one area we like, and those are really on sale at the moment. The other place we like are really high quality dividend paying companies that have, think about a moat around their business. Like, even though the banks in Canada are down, they're still going to keep overcharging all their customers, and it's really hard for people to go and compete with them. So we want to be in businesses where the companies are very healthy financially, have the ability to keep paying and raising their dividends, usually faster than the rate of inflation. And one idea I want to share with people that I think is pretty straightforward when we think about companies to buy is there's a very significant difference between companies that can set price and companies that take price. So I'll give an example of this because we haven't mentioned it here, but maybe we'll do another one about our Dirty 30 model, which we have embedded in a few other models. But this is a portfolio that I built a few years ago that takes the idea of companies that meet certain criteria, which I'll bore you guys with another time. But it's actually, we've been outperforming the S&P 500 with that model without a big overweight to technology. And it's simply by buying companies that have fortress-like balance sheets. Most of them pay really good dividends, but also this idea of being price setters. So what I mean by that is if you're Starbucks or if you're Ferrari, like what does a Ferrari cost? It costs whatever Ferrari tells you it costs. It doesn't matter what a Toyota costs or a McLaren. If you want a Ferrari, you will pay what they make you pay. And they get to build all of their margin inside of that, right? What does a Big Mac cost? Well, it costs whatever McDonald's tells you it costs. Now, there's a range of how much they can charge, but they don't really care what a Whopper costs or a Wendy's burger. Wendy's and Harvey's and Burger King, they have to pay attention because if McDonald's is charging this, they can't really go above that. So they're price takers. They take the price that's set in the marketplace. We want to be investing in companies that have the level of dominance where they set the price. So that way they can pass their costs along and protect the margins of their business. So to me, this is just fundamental of good investing. And it's interesting because when I look at things like AI, I don't really know how they make any money from that. Like that is such a new industry and nobody quite knows where the profit levers are. So I don't know how you generate margin and have the ability to protect it and be the price setter. Nobody is a price setter. We don't even know what the price is in those spaces. So to me, we really like the areas that have underperformed lately, but long term, they're the ones that I think give us the best opportunity to beat inflation and purchasing power, which I think are the primary risks. So let's just keep this moving here a little bit, Kristian. So why don't we talk about another change that we've been making or something we've taken advantage of, which is as a result of interest rates changing and what it's done to the fixed income market. Because we've been very light on fixed income for the last decade because interest rates were so low, but that's changed in the last 8 to 12 months, right?
Yep. So the math on fixed income has changed because we're in a much higher interest rate environment. And so I know we talked about this chart a little bit in our last presentation, but just to reiterate here, and especially looking on the right side, it shows what happens if interest rates were to rise 1% or fall 1% across different fixed income markets. And if we look at investment grade bonds, and those are your grade A quality companies, very low chance of default. Think of your big Canadian banks. They're not going to go down. They'll be able to make payments on their debt. They are going to be classified in this category. And so if interest rates were to rise 1%, you're looking at a negative 1.8% return. As we just discussed, even though there are some inflationary pressures still persisting, it's likely that most central banks, especially in North America, are still near the end of their hiking cycle. So another 1% rise in interest rates is unlikely. But if interest rates were to eventually fall 1%, and that's very likely over a longer term horizon, given if the banks can achieve their mandated targets, we're looking at a 12.5% return with an investment grade fixed income. So what does this mean at any for portfolio construction? It means opportunities to derive really high yields from quality, safe companies, from governments. So those are treasuries, Government of Canada bonds, guaranteed payment on these bonds, and add a level of protection to portfolios, but also hopefully take advantage of some capital appreciation and drive better risk-adjusted returns.
And we're seeing this across by the way, the bond market is about 3 times bigger than the stock market. People don't really realize that. So there's a lot of variation around the types of bonds and things because we're lending. So there's a lot of different ways we can lend. But what's interesting to me is across the board, we're seeing yields at the highest they've been in a decade. So now this stuff's actually interesting because rates have gone up so much to fight inflation. This, to me, as an investor, is the positive spinoff from this. So I think, we've been changing our models and we're continuing to change them to take advantage of this. We're not going to the best time to do it is when they're done raising interest rates, but that's impossible to call. So as long as we're near the top of it, I think we're good. But what this allows us to do is to add a high level of regular interest income into the portfolios. And as you mentioned, Kristian, if when rates do eventually start to fall, we're going to actually pick up an extra capital gain. So just so investors know with us that we've been making changes to the portfolio and continue to take advantage of the cards as they're dealt. So this is an area of really good opportunity for us. We've also been doing a lot of homework. So one of the benefits of adding Kristian to the team was another set of legs and hands to help do a lot of our own homework. So we've been doing a lot of one-on-one due diligence. We don't just read the reports. We actually go and meet management and talk to the senior people there. So, Kristian, we've been fairly busy, you in particular. So this is just a short list, actually, of some of the resources and we've accessed and people we've had one-on-one meetings with. So anybody in there that stands out or that you wanted to highlight?
Yeah, so we've had an opportunity outside of single name equity research that we continue to do on a regular basis. We've had an opportunity to meet with a lot of these companies, specifically management and senior personnel from these companies, to decide the best way to integrate them or not integrate them into our portfolios. So, for instance, Firm Capital, we had a very good meeting with them. I think it was last week or 2 weeks ago, with their COO, their head of their property trust. And those are significant investments that we hold within our portfolio. And Darren and I had a one-on-one meeting with them to get an update on their business, to reaffirm the trajectory of their business and ensure how they're positioned in this environment for success. We've had other meetings with several members, obviously on this list. It's quite extensive.
Yeah, we had the CEO. So yeah, we had the CEO of Middlefield come in and meet us in our office in Oakville. You and I went down to New York and spent the day with Capital Group on the stock exchange. That was a lot of fun.
Yeah, and then Fidelity, we had an opportunity to meet one-on-one with Jeff Moore, who's their head of their some of their significant fixed income products. So certainly a lot of these meetings...
Sorry, just to interrupt. That was actually kind of fun because Jeff doesn't do meetings with advisors. He doesn't, but we happened to get him because he was flying up to he lives in Boston, but he was flying up to his cottage in Muskogee. He has his own airplane. So he happened to come into Toronto for a meeting, and the senior people at Fidelity said, Darren, come in, have a one-on-one with Jeff, and Jeff was willing to do it for us. So we've actually developed a nice little relationship with him, which is good because it doesn't seem like he has one with any other Canadian advisors. So we were very fortunate to take advantage of that opportunity. And we have even more. So this is an area where Kristian has taken the lead, and again, having somebody on our team dedicated just to continually talk to these people, get the wisdom and perspective and information, I think just helps us have, again, a wider set of data to help filter and make decisions. So this is good, and this is what's filling up your dance card now, isn't it, Kristian? Lots of these meetings.
Yeah, so we have to, I guess, I think you're saying, Darren, is kiss a lot of frogs to find a prince or princess. So certainly a lot of meetings obviously helps inform us in our portfolio construction. As we mentioned, times have changed from the last 10 years. We're in a different environment. And so our duty really is to ensure that we're making sure the portfolios are best positioned to take advantage of these conditions.
Right, and just so we're clear, the frog can pick its own pronouns. So with that, I want to thank you, Kristian, for the work that you've done and you keep doing. For those of you who stayed with us for 45 minutes, I hope you enjoyed that. And I think that just gives you a little bit of a window to all the work we're doing. There were probably another 50 charts we could have put in, but out of the interest of time, we wanted to hit the most important ones. So just as our kind of key takeaways, and for those of you that skipped over the main part and just want to get to the outcome of this, just to summarize, we think inflation, we were kind of early to see that as a problem. I think it's going to be more persistent. The central bankers around the world are doing their very best to try and engineer a soft landing. The market certainly hopes that they do. I think rates are going to stay a little higher for a little longer than people think. Hopefully they do engineer a soft landing, but there is a bit of a risk of hitting the brakes a bit too hard. Because of interest rates having been generated up so high, that opens up an opportunity for us to add more fixed income into the portfolios than we've ever had to take advantage of that. So higher current income, and also when rates eventually do go down, we'll make a capital gain there. We're a bit worried about the narrowness of the market. It's really been 7 stocks that are priced to perfection, that are skewing all of the math. My experience says don't chase those. Don't keep putting more quarters in the same slot machine everyone else is paying attention to. Now's really the time to be looking at the places that everyone else is kind of forgetting or not interested in. And some of our favorite sectors where we have to go to generate rising income to fight inflation, like, again, in Canada, real estate, financial services, discretionary, consumer discretionary, places that are price setters that generate lots of dividends. At the moment, they're not in favor. So we'll have the discipline to buy low and eventually sell high. So that's kind of the short story of what we just talked about. So with that, Kristian, thank you very much. For everyone else watching, enjoy the rest of your summer. We're here if you need us for anything. I'm on a little bit of a campaign to do a lot of one-on-one calls. So the team will be reaching out to you shortly for a little 10-minute catch-up, because I miss seeing everybody in COVID and everybody's kind of gone away. So we're going to have a couple of connections. And we have an announcement of a new staff member that's joining us on July the 4th. So some more news on that coming up. But for that, Kristian, back to work. And everyone watching, thank you for your time.
Thanks, everyone.